Hi folks, welcome back to our series on depreciation and calculating depreciation. This is the second video in which we talk about calculating the calculating the declining balance method. This is some ways easier and some ways more complicated than the straight line method. We start out with only two pieces of information, but there's a third piece that we have to kind of keep track of as we go. So in this case, we're going to use our same asset, which is our car. And in this case, as I said, we only have two pieces of information. We have the purchase value of $32,000 and then the depreciation rate of 20%. Now, the problem is, and the reason why we call it the declining balance method, is that you can't keep multiplying that 32,000 by 20% year over year. It would be nice if we could, it'd be a lot simpler, but the problem is that the value of the car, as we use it up every year, it decreases in value. So what we're actually got to keep track of is the book value. That's what we want to multiply by our 20%. So on the first year, when our car is at full value, the book value is the same, as we will see in a minute. But then after that, it gets a little more complicated. We have to keep track of our accumulated depreciation. So I've got a little table set up here just to kind of help with the math a little bit. So we have our purchase price here, which is our 32,000, and then we have our interest rate here of 20%. Now, as I said, that's going to stay the same every year, so I'm just going to put that right in there now. Now, the first year, as I said, there's no depreciation on this at all. We are using the full value of the $32,000. If you're worried about this expression here, accumulated, don't. It's just, all that means is the added up depreciation over the years, whether it's 2 years, 3 years, 1 year, 10 years. It just means added up. So what we're going to do here is we're going to calculate the depreciation for each individual year and then sort of total that up, have a running total as we go. All right. So as I said, in the first year we have zero accumulated depreciation, so we don't have to worry about that. Normally what the step would be then for this one is we would want to take the purchase price and subtract off the book value, or subtract off the depreciation. In this case, as I said, there's no accumulated depreciation, so it's 32,000. This means that now we are going to multiply our 20% by the 32%. And so I'm just going to use my Excel math here. So I'm going to go equals and then times, which is the star key, over to my 20%. So that means that my depreciation for the first year of owning the car is $6,400. All right, so that would be the expense that I would have to put against my profit in year one. So just to make this easier, I'm going to do year one, just so we can kind of keep track here. 4 years should be enough. Okay, so now what we have to do then is we have to, as I said, we have to kind of keep track. We have to add up our depreciation from each year. So I started with 0. We have a brand new car with no depreciation. This year we have 6,400. So I'm going to add 0 plus 6,400. That gives me 6,400. Now what I have to do is I'm going to transfer that last number over to the accumulated depreciation for the next year. So the other simple thing about this is, and kind of this is in keeping with general accounting principles, as I've said in class, that 32,000 never changes, but what is going to change is the amount of the accumulated depreciation. So every year we're going to add more and more to this so that the book value is going to go down and down. Again, that's why we call it the declining method. So I'm going to go over to my 32,000. I'm going to subtract off my 6,400. So this year, as we can see, the book value, or the thing that I'm calculating depreciation on, has gone down from 32,000 to 25,600. I'm going to calculate my depreciation. So I'm going to take my 25 and change, multiply that by 20%. That gives me $5,120. So now I've got to calculate my running total. So I'm going to take my $6,400, add in the 5,120 to get my new balance, 11,520. So now to calculate for the next year, I have to carry forward this accumulated depreciation amount into over here, and I'm going to use a reference here just to make it easier. So this year I have to use 11,520. So the value of my car hasn't changed, or at least the purchase price. It was what it was when I bought the car. But now that we've used up $11,520, I can't keep claiming that full 32,000. I have to subtract that off. So I'm going to do that here. So now my book value is only 20,480, and then that's what I'm going to multiply by my 20%. So I'm going to do my math. That means that the depreciation for this year was 4,096. So I'm going to just kind of extend that down again. So now we can see in the first year we had 6,400 in depreciation. The second year we had 5,120, so we added those up to give us 11,500. Then the third year we had 4,095, so I'm adding that to the 11,520. So far I have got accumulated depreciation of 15,616. So that number I now need to carry down over here. There we go. And so I'm going to go through the same process then. So I'm going to multiply, or I'm going to subtract those two numbers, minus the 15,616, and then I'm going to do my multiplication. And so now my depreciation for this year is 3,276.80, and then I've got to do my addition. So there we go. So again, just to recap a couple of important steps. First of all is calculating the individual depreciation for each year, knowing that it's 20% of the current book value each year. And we calculate that book value by taking the purchase price and then subtracting off the accumulated depreciation for that given year. And so and then that's why we have to keep this running total of the depreciation, which we call accumulated depreciation. And this name will actually will become very important in the third video of this lesson. There we go.